Welcome back to the deep dive. Today we are immersing ourselves in the dynamic, and I have to say, often contradictory world of global flexible office space.
It's a fascinating area.
It is. We're zeroing in on International Workplace Group, or IWG, which is, this massive global operator.
The company behind Regus and Spaces, those people will have heard of those.
Exactly. They are basically the essential infrastructure for so many modern agile businesses. And right now, well, their global position is really being tested.
Yeah, the sources we've looked at, they present this really classic market dilemma for IWG.
How so?
Well, on one side, you have this immediate, pretty painful financial hit, a major profit warning that just sent shares tumbling.
Okay.
But on the other side, you see this really calculated strategic confidence play and a huge geopolitical shift.
So our mission today is to get past those immediate headlines. We really want to understand that core tension you're talking about. How can a global giant with what look like solid first-half results get punished so severely by the market?
And what do their bigger long-term moves like, pulling out of Russia and this massive share buyback? What do they tell us about how the future of work is actually being financed and managed?
It's a big question because IWG isn't just another company. They're kind of a bellwether for global corporate real estate.
Absolutely. They have, approximately 1 million rooms across 121 countries?
That's a huge footprint.
It is. So their performance, it doesn't just reflect their own health. It really reflects these bigger global trends in leasing, in risk assessment, and how companies are choosing to deploy their people, especially in volatile times.
Okay, let's unpack this. And I think we have to start with the financial pain, the thing that really grabbed all the headlines.
Yeah, the reaction was immediate, and it was harsh. IWG shares took a nosedive.
A sharp decline, right?
Plummeting 16%. They were trading around 193.5 pence. That level of a drop, it implies a really profound loss of confidence in the short term.
And the trigger for all of this was a forecast update from the company. They announced that their full-year EBITDA, so earnings before interest, taxes, depreciation, and amortization, was expected to land at the lower end of their guidance range.
Exactly. And their stated guidance was between $525 million and $565 million.
Which is still a massive amount of profit.
Of course. But hitting $525 million, the low end, that creates this big psychological hurdle. The really critical factor here is the market consensus.
What the analysts were expecting.
That's it. Analysts were looking for EBITDA closer to $540 million. So when you miss that consensus expectation, even by just projecting the low end of your own range, that's what sends the market into a selling frenzy.
It's the expectation gap, not necessarily a total collapse of the business.
Precisely. Investors price in that consensus number. The moment a company says they won't hit it, the reaction is almost algorithmic.
And that pain wasn't just limited to the earnings, was it?
No. The sources also point out that the outlook for free cash flow was a problem.
Ah, the real engine of the business.
Right. IWG projected at least $140 million in free cash flow, which was just weaker than investors had been hoping for.
And when you trim both the earnings forecast and the cash flow outlook at the same time,
the market gets extremely nervous. It's about capital allocation, liquidity, all the fundamentals.
This brings up a really fundamental question for me. Is this stock punishment reflecting a deep flaw in their business model, or is it just the market reacting, maybe hysterically, to an ambitious analyst consensus they couldn't quite hit?
I think that's the right question.
Because if we actually peel back the numbers, their immediate performance was, from what I can see, actually pretty strong.
That is the crucial nuance that the headlines just completely missed. When you dig into the first half results, the actual data they posted, not the forecast, the underlying business machinery looked robust.
We have some concrete data on this. Adjusted EBITDA for the first 6 months, it actually rose by a healthy 6% to $262 million.
And what's more, that first half number met the consensus estimates for that period.
So they walked into the second half of the year exactly where analysts expected them to be.
Right, and this is where the strategic story gets much clearer. It's about the improvement in operational efficiency. This isn't just about hitting old targets. It's about the quality of their earnings.
Okay.
Recurring management fee revenue, that showed growth. That points to sticky, stable, long-term revenue. And critically, their EBITDA margins expanded to 14.2%.
A margin jump to 14.2%. That's not an accident. That tells me they're running a fundamentally more efficient operation.
It does.
And this leads us right to the heart of it, doesn't it? Their capital-light growth strategy.
Exactly. To really get IWG's resilience, you have to understand the strategic pivot they've made.
They're moving away from being a traditional real estate company.
Think of it like a big hotel chain. They used to own or, lease huge amounts of very expensive property. That's asset heavy, high fixed costs, high risk.
And high fixed costs mean that if your occupancy dips even a little, the loss is immediate and can be dramatic. That was the old Regus model.
The capital light strategy just flips this on its head. Instead of signing these long fixed-rate leases themselves, IWG is relying more and more on franchising and management agreements
So they're shifting from being the primary leaseholder.
to being a service provider. They manage the operations, the technology, the branding, all for a fee. The risk, the big capital burden, that stays with the local property owner or the franchisee.
So that margin expansion we just talked about is directly tied to this change. They're scaling up their brand and their network, more managed in franchise openings, without taking on all the liability themselves.
It is highly effective operational leverage. They're essentially outsourcing the risk while boosting that recurring fee-based revenue. That 14.2% margin is the sound of the capital light strategy working on the ground.
Even while they're dealing with, geopolitical issues and inflation.
It makes that short-term profit warning look more like maybe a timing issue in transitioning the whole business model, rather than some kind of catastrophic flaw.
But that transition, it relies on having a stable global footprint. Which brings us to the next big strategic decision, one that goes way beyond next quarter's earnings.
Their withdrawal from Russia.
A calculated withdrawal.
Yes. This decision is a pure response to geopolitical risk driven by the invasion of Ukraine. IWG confirmed they're ceasing operations in Russia, which signals a clear alignment with that whole international corporate exodus.
This geopolitical move adds a really fascinating layer to the financial story. Our sources say they operate 9 offices in Russia. Now, 9 offices and a global portfolio of 1 million rooms, it doesn't sound like a massive sacrifice.
Not on the surface, no. Especially since those locations were primarily serving international companies that were already scaling back or leaving anyway.
So is this a principled strategic statement or just practical economics?
I think it's both. But the way they're doing it, the execution, highlights the strategic calculation. The CEO, Mark Dixon, said the company is pulling out gradually, meaning they're going to wait for the existing leases to expire. And that phased approach is crucial because it minimizes the financial hit.
If they just broke the leases immediately, they'd be hit with huge termination penalties.
Millions in cash flow, gone. By waiting for the leases to expire, they minimize that immediate cash burn. It makes the geopolitical exit financially responsible.
It's risk management in action, protecting the balance sheet.
And what's equally interesting is what they're doing elsewhere. They aren't just leaving risky areas. They are actively supporting the flow of business out of crisis zones.
Yes, the sources highlight IWG's role in helping companies that are relocating from Ukraine, helping them set up new operations in safer places.
They're effectively acting as a corporate migration service.
Which countries are mentioned?
Specifically, Poland, Romania, and Portugal are named as places where IWG is absorbing this influx of displaced business. It really shows the power of having such a vast network.
When a company has to suddenly pivot to a whole new country, a flexible provider like IWG is one of the only options that can provide that ready-to-use infrastructure almost overnight.
Exactly.
And this ability to pivot, to absorb geopolitical shock, it leads us to the final, and I'd say most confident, signal that management sent to the market.
Right. Despite the share price crash, they doubled down.
They did. Management basically decided the market was overreacting, and they put their cash where their mouth is.
IWG increased its current year share buyback program by an extra $30 million.
Which brings the total commitment to at least $130 million. Let's just put that number in context for a second.
Sure.
We just noted that their minimum free cash flow forecast was $140 million.
Right.
Committing $130 million, nearly all of their expected free cash flow, to buying back their own stock is an extremely aggressive move.
It's more than aggressive. It's a profound signal. Share buybacks tell you that management is absolutely convinced the company's stock is undervalued by the market.
They're essentially saying, we believe investing in our own stock gives a better return than almost anything else we could do with this cash right now.
It's a loud declaration of faith in their own long-term prospects.
And this connects directly back to that capital-light growth strategy we were talking about.
It does. CEO Mark Dixon emphasized that the buyback flows directly from that strategy, which is designed to deliver strong cash flow and simplify the business.
They would never commit this much cash if they weren't confident in that recurring low-risk fee model.
And they can afford to be this bold because the foundation is just so large. This isn't some risky startup trying to fake confidence.
No.
IWG has, again, 1 million rooms, 121 countries, and a huge pipeline of managed and franchise locations ready to go. Their sheer scale lets them make these big financial moves to stabilize the stock during these periods of investor anxiety.
So we've taken the IWG story and we've broken it down. You have the headline, grabbing short-term anxiety about missing an ambitious profit target.
And that's contrasted sharply with these long-term, really calculated strategic moves.
The financially responsible exit from a geopolitical hotspot, and this huge confidence-signaling share buyback program.
If we connect all this to the bigger picture, what we've really analyzed today is the complex art of navigating global risk in the modern marketplace.
It's a fine line to walk.
It is. It forces management to maintain rigorous financial discipline, that's the capital-light strategy, while at the same time executing these timely strategic withdrawals to protect the brand and avoid, unnecessary cash drains.
So what does this all mean for you, the learner? I think it means that when a global player announces earnings at the lower end of their guidance, you just can't stop at the headline. You can't stop at the 16% stock drop.
I have to look deeper.
You have to look for those countervailing signals that management is sending to sophisticated investors.
The rationale behind the geopolitical exit.
And most critically, the cash being committed to share buybacks and the evidence of margin expansion. Those are the truest indicators of long-term belief.
It's the difference between a market being disappointed and the underlying business being structurally healthy.
Right.
They're showing the market they're using their cash flow to invest in themselves.
Absolutely. And let's end with a provocative thought that sort of builds on their role in this corporate migration trend.
Okay.
The source material shows IWG helping companies relocate to places like Poland and Portugal from Ukraine. So, considering the scale of their network, how might major flexible office providers start to shift their infrastructure priorities and their investment focus to reflect not just where business is booming today,
But where business is fleeing to.
exactly, where it's actively de-risking its operations across the globe? It could fundamentally change the criteria for where you choose to invest in real estate in the future.